Question number 3. Why should I consider, or why should we consider investing in a money market fund? What advantage or what reason should I have? One is easy access or quick access to your money. And this is what makes a money market fund highly suitable for you keeping or parking your emergency incomes or creating your emergency fund. Unlike the bond market, one is that if you were to liquidate your investment in the bond market, be it a treasury bill that you want to sell or a bond that you want to sell in order to obtain money for your use, you would require an intermediary, a broker, to perform that sale in the stock exchange. And not all the time you will get a buyer for your instrument. Although the central bank operates as a buyer of a last resort, and in that case, if it is central bank that would buy your security because you have lacked a buyer and is quickly in the secondary market, you will have to lose a part of your gain because central bank purchases by discounting. And number 2 is that it will take a process for central bank to buy your security. But when you look at a money market fund, you easily access your money because number 1, under the law, money market funds should not have locking periods. And in any case, the design of a money market fund has a locking period and it's authorized by the regulator as such, then you are supposed to be informed before you invest that you are investing in a money market fund that has a locking period. And the number 2 is that in a money market fund environment, in the money markets is more or less of an exchange of money. And that's why it is so quickly accessible because it is exchanged on a 1-to-1 ratio. The one coming in for investment and the one that is asking for a refund, it's an exchange. There are no capital gains within the money market environment. And that is one reason it is easy to access money in a money market fund. Number 2, it's access to the 3 E's. That is education that has given the operator, the fund manager, and the other parties involved in investing and managing the fund, they have relevant education that has equipped them with the skills that help them in market adaptation and mitigation of risks. In the same vein of 3E, it's expertise that these professionals in the investing environment within a fund operation have, out of experience, which is the 3rd E, they have developed skills and experience that qualify them to be experts in that field. So your inadequacy of skill and knowledge with regard to investment, which might yield a risk in your investment, will be sorted out in the use of the fund manager and the other persons who have education, give them the right skills, exposure, and experience in investments. Another reason to use a money market fund as opposed to going direct in the market is leveraging on time. While you have time is one of the greatest resources that we have, and as an individual being the best asset that you can have, you have enough time to dwell on other things, generation of more revenues, more incomes, while you leave the challenges of investment to those who are good at it, and that is the fund manager and his team. A fourth one is flexibility, and flexibility talks of options. In a money market, or the fund manager offers options to you as an investor, because that is, money market fund is not the only fund that the fund managers operate. We have a balanced fund, we have fixed income funds, we have equity funds, and we have bond funds. On top of that, a money market fund, on virtue of the different securities that the fund manager is authorized to invest in, flexibility is that the fund manager is not allowed in law to invest more than a quarter of the fund in one investment. So it diversifies to a minimum of 4 investments in one fund. That mitigates risk. Question number 4. Under what circumstances can your right as an investor to withdraw money or access your money in the fund be suspended or curtailed? That is an unfamiliar territory with many people with regard to money market funds, because they say that at any given time you must get your money. But money market funds, like any other opportunities, are affected by market dynamics, economy dynamics, political dynamics, and circumstances. And there exist circumstances that poses risks as to which your right to access your money and to withdraw your money as an investor may be suspended. And one such circumstance is when we lose an investment. A good example is, remember when Nakumatt Holdings supermarket, the chain was going down. One fund that has invested in Nakumatt lost a quarter of its investment by virtue of that. And that happens. In the event an investment is lost, such a circumstance is a risk that may lead to that happening, a suspension to build up the fund again. Another one is in the event of a default, where in the investment, if it is the government default in paying the interests or the principals on maturity. But I'm using the government as an example. Money market funds are not only invested in governments, they are also invested in as bank deposits with the banks. They are also invested in the private sector and the commercial papers. So in the event of default, that right might be suspended. And the third circumstance is in the event of the fund losing due to adoption of high-risk investments due to collusion between the fund manager, the trustee, and the custodian, which is a rare occurrence. So because the 3 or the 4 chances or circumstances are rare, that's why we say that money market funds are low risk investments. But in terms of investment, when you're looking at the risks, exposures, what has been invested with the government, that is in treasury bills, that would be the lowest risk exposure in terms of the fund investment, because hardly will a government default on payment unless it's a circumstance like the country is in war and such like. which are normally not quite easy. What has been invested with banks, the highly negotiated bank deposits, are in moderate risks, and the one that may give us some risk exposure is the proportion that has been invested in the corporate private companies as commercial papers. So, and that is now speaks to the risk exposure as outlined by the fact sheet. When you look at the fact sheet of a particular market fund, you are able to tell where they invest their money, and by so doing you'll be able to analyze or to speak towards the kind of risks that fund can face. Question number 5 is, why do some money market funds give a high return compared to other money market funds? As I've said, money market funds, they will suffer factors originating politically, economically, market dynamics, and circumstances. The rates keep on fluctuating. Interest rates offered by money market funds are not fixed. They keep on changing. Now, in a particular period of time, a money market fund will have invested at the existing rate. And when the rates change and the fund manager would want to take up investment in the new higher rates, it means the fund manager must flip or dispose the investments in the lower rates in order to liquidate enough money to invest in the new higher rates. For huge fund managers or for established in money market funds sitting with long investing fund managers in the market and holding huge funds running into hundreds of billions, such huge amounts may be difficult to liquidate in a short period of time. And therefore, as depending on the period that it will take for the market to stabilize and the interest rates to stabilize, it may not offer enough time for the fund managers operating huge funds to liquidate the existing investments, garnering lower returns in order to take advantage of the current ones that are giving high returns. That is basically the main reason why we have funds that are paying lower roll rates compared to others. If you look at the many that pay the high rates, they are the new entrants in the market, and so they are still growing their fund. And to that is that the average return for the period they have operated since they joined the market, it will speak to relatively what have been the rates of returns, because the dividend yield curve, the interest yield curve, or in essence, the return yield curves speak better than the rates that we get. So basically is on question of the ease of flipping the fund. We'll look at question number 6 after the next 3-second break.